Hello, I'd like to welcome you to our investment report video presentation on behalf of the Tulane University Burkenroad analyst team covering RPC Inc. Our team of analysts includes Carrie Burke, Will Cornegie, Alejandro Paredes, Juan Paez, and Paul Schemmel. RPC trades on the New York Stock Exchange under the ticker symbol RES. We predict a 12-month target price of $12 per share, which is an increase of 4.99% from its price of $11.43 per share on October 26, 2012. This increase is consistent with the Burkenroad's market perform rating. Today we will cover what RPC does, we'll give a brief industry overview, we'll talk about the competitive landscape in which RPC operates, we'll talk about RPC's business strategy in the coming year, and our valuation of RPC. What does RPC do? RPC is a holding company that includes Cut Energy Services, Patterson Services, and Through Tubing Solutions. The company offers technical and support services and equipment rentals to independent and major oil field companies engaging in the exploration and production of oil and natural gas. RPC offers a variety of required field services, primarily pressure pumping, downhole tools, coil tubing, rental tools, and several other service lines. RPC's most lucrative business segment is CUD's pressure pumping service line, which consists of fracturing and acidizing services used to enhance production in existing land wells. Pressure pumping services accounts for 52% of RPC's total revenue and has been the fastest growing business segment since 2000. RPC's primary customers include mostly domestic, yet some foreign, oil and gas production companies, as well as integrated energy companies. Presently, RPC is headquartered in Atlanta, Georgia. And in 1984, Cudd and Patterson were spun off from Rollins Inc. due to severe industry downturn to form RPC. Today, the company has a market cap of $2.4 billion and a very conservative balance sheet marked by its low debt. To begin a discussion about the industry in which RPC operates, it is important to note that the oil and gas field services industry depends heavily on the demand and prices of these commodities. As of November 2012, the price of oil has fallen nearly 13% from November 2011 to $87.79 per barrel. And natural gas prices have fallen over the same period 19% to $3.74 per million British thermal units. In recent years, warm winters and a natural gas glut have kept the price of natural gas far below the 2008 high of $11.25 per million British thermal units. The falling prices of oil and natural gas indicate a market weakness, hurting revenues in the field services industry. The success of this industry has a strong positive correlation to oil and natural gas prices and the political and economic environment in which these companies operate. While the threats of entry and the threat of substitutes for the industry are relatively low, the nature of the oil and gas services industry is highly competitive. Because the industry is inundated with thousands of companies worldwide, customers of oil and gas services have high bargaining power. RPC's customers determine prices because they do not view the services provided by any field service company as significantly differentiated enough from its competition to pay a premium. The few suppliers for the service industry dictate prices for materials and equipment because of the high demand for materials such as proppants. These forces create a highly competitive environment among competitors, which is further heightened by the current low pricing and low fleet utilization in the industry. The highly competitive nature of the oil and gas field services industry creates a tough competitive landscape for RPC. RPC must compete with both large cap companies such as Schlumberger and Halliburton, as well as small cap companies such as Basic Energy Services. Based on market size, products and services offered, and geographic location, we concluded that RPC competes primarily with Superior Energy Services, Patterson UTI Energy, P Energy Services, and C&J Energy Services. RPC's management has demonstrated its effectiveness compared to its competitors through its high return on equity of 41.34%, very high compared to its peer average of 23.62%, which shows that RPC efficiently uses shareholder investments to increase the company's profitability. Moving forward, RPC plans to continue its growth through maintaining a conservative debt position, increasing market share, and expanding geographically. Since 2008, RPC has consistently made acquisitions of specialized service companies and investments in property, plant, and equipment in order to serve a larger customer base more easily. However, management indicated that in the coming year, the company will not continue to actively seek major acquisitions or investments because of the current glut in natural gas. Due to the current low price of natural gas, it is not profitable for exploration and production companies to invest in natural gas wells. Therefore, there's a significantly lower demand for RPC's services in these regions. To combat lower demand in the natural gas market, RPC plans to strategically allocate its service fleets away from gas-producing basins, such as Appalachia or Eagle Ford, to more active oil-producing basins to ensure all fleets remain in operation. Management plans to increase its presence further in the Permian Basin, which already accounts for 40% of the company's pressure pumping services, and also the Bakken Shale Basin in North Dakota in the coming year. Many other companies in the oil and gas field services industry face similar problems to RPC and are similarly moving to oil-producing basins. Therefore, these basins will be increasingly competitive in the coming year. RPC aims to maintain its market share by strengthening customer relationships and relying on its diverse array of specialized service lines. RPC maintains a conservative capital structure to protect themselves in times of economic or industry downturn, which the company is now facing. RPC has an 18.91 debt-to-equity ratio compared to a peer average of 46.76. And in August of 2011, RPC replaced its $200 million credit line with a $350 million revolving credit line supplied by multiple banks at very low interest rates. RPC's conservative capital structure allows the company to easily access financial resources and avoid operational disruption. While other oil and gas field service companies have incurred large debt expenses in a depressed industry, RPC's financial structure has allowed it to maintain better margins in comparison to its competitors. Now let's talk about how we reach our $12 target price. We constructed a revenue-driven model that could predict RPC's future growth. The company's revenue was predicted using a regression model using the following variables. First, oil rig count. Using Baker Hughes as a source, we used the American land-based oil rigs to help predict the behavior of revenue. Given that RPC is a field service company, its incomes depend largely on the number of oil rigs companies are willing to open. We chose the domestic land-based rigs because the vast majority of RPC's operations take place within the United States. Secondly, we used horizontal oil rig count. Taking a look at the company's operations, we saw that the company derived a large portion of its income from fracking operations, which take place when drilling horizontal rigs. As a consequence, to make our revenue model more accurate, we used Baker Hughes oil rig count to find out how many horizontal rigs were active in the United States. Thirdly, we used oil price, leading to periods, and natural gas price. Given that oil companies are more willing to increase their exploration and production activity when oil prices and natural gas prices are high, we saw the price of these commodities as a good proxy for determining how RPC's revenue will grow. An increase or decrease in the price of the commodity does not immediately affect RPC. Rather, there is a 2-period lag before the revenues significantly change. Consequently, we used a 2-period lead for oil prices to make our model more accurate. When running the correlation, the results show that the prices of natural gas were not accurate predictors of revenue. Thus, we had to omit the account from our analysis. The final variable we used for predicting RPC's revenue was the company's investment in property, plant, and equipment. In order to grow its business, the first thing RPC must do is grow the company's capacity to serve customers. In this case, growing the company's investment in PP&E. This situation led us to believe that the investment in this line item is a good predictor for how the company will perform moving forward. These assumptions helped us to determine our 12-month target price of $12. We found this value by taking the weighted average of 4 valuation methods: the relative multiples method, the discount dividend model, discounted owner's earnings, and traditional discounted free cash flows. The relative multiples method is a valuation method that relies on financial information of RPC's benchmarks to arrive at a valuation figure for the target company. The dividend discount model uses predicted dividends to be paid by the firm and discount them back to the present value. This method is a reasonable approach for a company like RPC because the firm has had a consistent dividend payout strategy. The third method used takes into account the company's expected net income for future periods and brings it back to the present by utilizing a weighted average cost of capital as a discount rate. As the discounted owner's earning model does not take into account the company's ability to convert earnings into actual cash flows, we decided finally to also apply the traditional discounted free cash flow method. According to our 12-month target price, we give RPC a market perform rating. Based on this target price, RPC stock will yield a 4.99% return solely because of a stock increase. Additionally, according to our forecast, RPC will continue to follow consistent dividend payout strategy, which would consist of 4 quarterly dividend payments summing to 32 cents for the upcoming 12-month time horizon. If we sum the stock price appreciation and the forecasted dividend payments, investing in RPC would yield an approximate annual rate of 7.99%. The Burkenroad reports are produced solely as a part of an educational program at Tulane University A.B. Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment. Thank you very much for listening to our video presentation today. And for more information on the Burkenroad Fund and for a more in-depth analysis of RPC, please visit www.burkenroad.org.